Welcome to The Explainer. Today, we're tackling one of the most famous and maybe one of the most misunderstood rules in all of personal finance, the 4% rule. For decades, this has been the go-to guideline for a safe retirement. But does it still hold up? And is there a better way? Let's find out.
All right, we're going to kick things off with a pretty bold claim. It gets right to the heart of what is probably the number one fear for anyone even thinking about retirement: the fear of having to sell off your hard-earned nest egg piece by piece just to pay the bills.
Whoa, that is a strong statement. The person who said this believes the rule has a really basic common sense flaw. But before we get into what that flaw is, let's just do a quick refresher so we're all on the same page about what the 4% rule actually is. Seems simple enough, right? This has been the bedrock of retirement planning for ever. The whole idea is that your portfolio will grow enough over time to support those withdrawals. But here's the thing. The problem isn't what you're doing, it's how you're doing it. Specifically, how you get that 4%. And this, right here, is where the trouble starts for a lot of people. This classic 60% stocks, 40% bonds mix is designed to give you a nice balance of growth and safety. But it puts retirees in a really uncomfortable spot when it's time to actually generate cold, hard cash. This is the million-dollar question, isn't it? So your portfolio creates cash in two ways: stock dividends and bond interest. But what happens if that cash doesn't add up to the 4% you need to live on? Well, you have to sell off some of your assets, your stocks, your bonds, to cover the difference. And for so many people, that just feels incredibly risky. And you know what? That nervous feeling, it's not just paranoia. When you look at the historical data, this income gap isn't just some theoretical possibility. For most of modern history, it's actually been the reality. To a lot of retirees, this feels like they're being forced to slowly drain their life savings. So let's look at the numbers behind this anxiety. And we'll start with the stock part of the portfolio. This number is kind of staggering when you think about it. For nearly 85% of the years between 1960 and 2023, the dividend yield from the S&P 500 was less than 4%. So for the huge majority of our lifetimes, stocks alone didn't even come close to producing enough cash to hit the target. And this chart just illustrates the problem perfectly. You take the average stock dividend yield, you combine it with the average bond yield in a 60-40 portfolio, and you end up with about 3.2%. But you need 4%. That leaves 0.8% gap that has to be filled by selling your assets. It means that, year after year, you're almost guaranteed to be selling off your principal. Okay, so if the income is pretty much always too low, and you're constantly having to sell shares, why hasn't the 4% rule just been completely tossed out? Why are we even still talking about it? Well, the answer comes down to a really crucial distinction that kind of changes the whole conversation. The argument that the rule fails because the income is too low is, in a way, what you'd call a straw man. It's attacking a problem the rule was never actually designed to solve in the first place. See, the 4% rule was never meant to be just an income rule. It has always been a total return rule. That means it accounts for both the cash your portfolio spins off and the growth in the actual value of your assets. So from this point of view, selling a small piece of your portfolio that has grown in value isn't a sign of failure. It's literally part of the plan. And the data backs this up powerfully. This number, 95%, represents the historical success rate of the 4% rule over 30-year retirements. This is according to the famous Trinity study and all the updates to it. So even with that constant need to sell assets, the total return, the growth plus the income, was strong enough to make it work almost every single time. But what if that logic just doesn't sit right with you? What if the whole idea of selling your principal, especially if the market is crashing, is just a complete deal breaker? Well, if that's you, there is another way to think about this. This strategy is often called dividend growth investing. And instead of focusing on total return, the entire game plan here is to build a portfolio that acts like your own personal pension, one that just spins off enough cash from dividends to cover all your expenses, while the principal, that gets left untouched. So here's a popular way to do it called the 5-4-1 plan. Step 1, you build a portfolio of stocks that altogether yield 5%. Step 2, you live on 4% of that income. And step 3, this is the secret sauce, you reinvest that leftover 1%. That creates this amazing snowball effect, growing your income base every single year, hopefully even faster than inflation. So the big question is this income-first approach just a nice, comforting idea, or is it actually a solid, data-backed strategy?
Let's put it under the exact same microscope we used on the 4% rule. I mean, the appeal is obvious. You totally eliminate that fear of selling your stocks low during a market crash, which is a huge source of anxiety for retirees. And the historical backtests? They show a success rate that's nearly as high as the total return method. Plus, getting a dividend paycheck that grows every year, that's an amazing hedge against inflation.
But, as we all know, there are no free lunches in finance. By focusing only on high dividend stocks, you do risk missing out on some of that explosive growth from other parts of the market. And you have to be really careful not to fall into what are called yield traps. Those are companies that offer a super high yield only because their stock price has totally collapsed, and they're probably about to cut that dividend anyway.
This table just lays it all out so clearly. The standard total return strategy, it has a slightly higher historical success rate and a bit lower volatility. The dividend strategy has a slightly lower success rate, can be a little more volatile, but, and this is the whole point, it delivers on that all-important goal of never having to sell your assets to fund your retirement. So after all that, where does this leave us? We've looked at the data, we've looked at the pros, and we've looked at the cons of two very different, yet historically very successful ways to approach retirement. The thing is, the data doesn't really declare a single winner here. The 4% total return rule isn't broken, and the income-first strategy isn't some magic bullet. They're just two different, totally valid paths to the same destination, and each one comes with its own set of trade-offs. And that, really, is the final question you have to ask yourself. There's no single right answer for everybody. Are you comfortable selling assets as part of a proven plan to maximize your portfolio's total value? Or does the peace of mind that comes from a predictable, growing paycheck, when you never have to sell a single share to get, outweigh the potential for higher growth? Your answer to that question will tell you which path is the right one for you.